If you're thinking of buying your first home or moving up to a bigger one, you need to understand the implications that your mortgage will have on your take-home pay. For most people buying a home, it will actually increase their disposable income. Many of my clients right now are seeing tax refunds of $5,000, $10,000, even $15,000. And that kind of money can be a complete game changer when considering buying a home, especially with today's interest rates. When most people prepare a budget, they often look at what they're spending and saving today, and then based on that, they come up with some mortgage payment that they think they can handle. But one key flaw in that process is not considering that your take-home pay might actually increase with the new mortgage. And that's because our tax code allows the mortgage interest and the property taxes to be written off against your top line income. But like everything in our tax system, it's a bit confusing. And in this video, I'm going to give you the specific calculation I use to see approximately how much less you will pay in income tax, or better said, how much extra money you'll have each year to spend or save should you choose to buy a home. Now, the reason for this video is that this topic, mortgage interest tax savings, it's either not talked about enough, or if it is, it's often pitched incorrectly by lenders and realtors to show savings that is much larger than actual. The calculation I'll share with you today has been validated by many clients after filing their taxes, as well as talking with their CPAs. But before we begin, a quick legal note: I'm not a CPA, and this is not tax advice. So please consult your tax professional to validate your specific situation. First, let's make sure you understand exactly how you are taxed. In the US, the tax system is progressive. That means that not all income is taxed at the same rate. Your income is broken into different brackets, and each of those is taxed at a different amount. Every dollar you earn is only taxed on the specific bracket that it falls into. So here you can see the federal income tax tables for singles and for married filers. As your income rises, so does the tax rate on that specific bucket of earnings. We also have state income tax, which obviously is going to change from state to state. Some states have a flat tax rate where everyone pays the same, others a marginal system similar to the federal taxes, and believe it or not, some states even don't charge income tax. And now the fun part, and that is tax deductions. A tax deduction is an amount that you subtract from your income to reduce your top tier marginal tax rate. Now, to simplify the tax code, the government came up with something called a standard deduction. This is a flat amount that automatically reduces the income for everyone, homeowners, renters, like whoever. That means that they do not pay taxes on that amount of money. This amount changes year over year, and in 2024, it was $14,600 for singles and $29,200 for married couples. Your write-offs must exceed the standard deduction limits in order for you to pay less in income tax. Now, deductions can include medical expenses, charitable contributions, mortgage interest, property taxes, and state income tax. But this is where the mortgage tax deduction gets a little complicated. I'll give you my refund formula in just a minute, but first, you need to understand some basic principles. And while we pause, if you find value in this video, please give me the thumbs up and forward this to anyone you know that might find this topic helpful. And be sure to subscribe to my channel, as I have weekly video updates that discusses everything you need to know about real estate and financial markets. And now back to tax savings. Now first, you may have heard the phrase SALT deductions. That stands for state and local taxes. This became a hotly debated topic during the 2017 tax reform battle. It basically is when the rule changed to limit those SALT deductions to just $10,000. That means if your property taxes are $5,000, and let's say you pay $10,000 in state income tax, you're actually limited to write off $10,000, not the entire $15,000. Next, realize that the interest you pay over time decreases because your mortgage payment includes both principal and interest. With each payment you make, the principal balance actually decreases, and with that, the interest charged drops as well. Speaking of interest, the tax law change of 2017 also limited the mortgage interest tax deduction to interest paid on a mortgage up to $750,000. That means if you have a mortgage of $1 million, you can only write off the interest paid on the first $750,000. And lastly, you need to know your marginal tax rate. Now, I'll put the links in the description for both federal and state calculations, but if your total income is cresting the bottom of one of those tax buckets, you should probably use the bracket that is just beneath that. For instance, if your tax rate jumps from 22% to 24% at, say, $100,000, and you make $105,000, you should probably use the 22 and not the 24, just to provide a little bit of a buffer, because these deductions will come from the top. Before I go over the calculation, you will need three things. First, the approximate mortgage balance you're seeking. Next is your interest rate, and then the sum of your top tier federal and state tax rate. An example always makes everything easier to understand, so I'm going to use a single person with an income of $140,000 in Washington, D.C. Their federal tax rate for that bucket is 24%, and their D.C. state tax is 8.5%. That gives them a total top marginal tax rate of 32.5%. Their desired loan is $550,000, and the interest rate is expected to be 6.75%. And now for the calculation. You take the annual mortgage interest and you subtract the standard deduction and multiply that by your top tier tax rate. But let's get a little bit more specific. We said earlier that your tax deduction you receive, it only exists if your write-offs exceed the standard deduction. And the SALT deductions are part of that equation, which again is limited to $10,000. So in my region, the Baltimore DC metro area, it is highly likely that anyone capable of buying a home, that they're gonna hit that $10,000 cap. So as a result, we will take this standard deduction and we will subtract $10,000, the SALT limits. Now, in states with no income tax, you will simply deduct the amount of your annual property taxes, as long as it doesn't exceed $10,000. And that leads me to my basic tax savings rule, which is that you can write off all interest in excess of $4,600 for singles and $19,200 for married couples. The next step is to calculate how much interest you'll pay on that loan in that year. An easy way to do this is to take your loan amount that doesn't exceed $750,000 and multiply that by the expected interest rate. This gives you an amount of annual interest. Now, given you pay less interest over time due to just the balance decreasing, some people choose to take that number and subtract like $1,000 or so, just to be a little bit more conservative. And now back to our example. We have a single borrower, which means the standard deduction we're going to use is $4,600. The loan was $550,000 at a rate of 6.75%. So if you do that math, that's $37,125. Now I'm gonna shave off $1,000 and let's say use $36,000 for my calculation just to be a little bit conservative. From here, you'll take the annual interest, which is $36,000, and subtract the $4,600 remaining from the standard deduction, or $31,400, and multiply that by their top tier marginal tax rate, which was 32.5%. That would be an annual tax reduction or a refund of $10,205. That's amazing, right? These higher mortgage payments, they become much easier to manage when you know your take-home pay is increasing by $850 a month. Now, let's say this person's about to get married. The standard deduction would then be $19,200 after removing the SALT limits. We also need to adjust our tax rate, right? Because now we're married. So looking at the tax chart, $150,000 of income drops the tax rate to 22 for federal, while DC stays at 8.5%. for a total tax rate of 30.5. Doing that same calculation, using some of these new numbers, the tax refund actually drops to $51.24 or about $425 per month. Now, I know I just upset a few people with that little nugget. In this scenario, at first glance, it appears getting married is actually more expensive, given that this person just lost $425 a month in their mortgage interest tax credit. However, because married income tax brackets are adjusted, they actually save $500 a month because those brackets are lowered. So getting married, after all, still saves you money. Sorry, fellas, you can't use this as an excuse. The US tax code is so confusing, and there really are many moving parts. You know, every financial move you make in life will have consequences. The key is understanding how everything is connected and to surround yourself with people who can guide you through understanding all of it. This could be a CPA, a certified mortgage advisor like me, financial advisor, friends, family, or anyone in your life circle who's open to talking about financial impacts of your life decisions. So there you have it. You now know how to get a rough idea of how much extra cash you should have should you buy this home and take on a mortgage. In our next video, it'll be real short, I'll give you a few quick tips on how you can validate these findings to ensure they're correct, as well as give you a little hack to how you can get that money back during the year rather than waiting until tax time to get the big refund. I look forward to seeing you in our next video.